I'm Holly Mackay. I run a business called Boring Money. This is what I normally look like, but after 2 days of homeschooling, that was me at the end of the day yesterday. So, Mackay, don't worry about everyone having heard you swear. I don't know what you said, but it can't have been that bad compared to swearing going on in all of our households over the last week. So this is us. This is what we're up to at Boring Money. We help British investors who want to either validate what they're thinking or they just don't know where to start and they come to our site. We know that there are 12 million non-advised investors in the UK, and of those, a really high proportion tell us that they don't feel confident at all about what they're doing. Now, there are 400,000 visitors to our site last year, and our blog is a really key source for us of getting feedback from investors. I'm going to share some of that feedback with you over the course of the next half hour. It means we're able to be very responsive and go out to them and take the temperature of what they're feeling at the moment. Last year, we had over 125,000 click-throughs from our best buys pages to provider pages. So people increasingly coming to us for a sense check on where they can go to invest and who's any good. And then, of course, working with the industry, we're gathering all these customer insights. We're supporting businesses with data, with qualitative research as well, doing a lot of market testing and writing various reports. And our new product we've launched, Offering, there's me coping with homeschooling after a very trying time trying to run a business and look after kids as well. But let's kick on to what we're going to talk about today. We're going to draw on research we have from a report we published a few weeks ago that draws on NatRep research with over 6,000 people. So we're going to share some of their views and comments there. But also last weekend, we went out to our kind of blog readers and our Boring Money audience and asked them quite detailed questions about how they were responding to this market crash, what they were planning to do. And I'm going to share that over the next 20 minutes with you. So just to recap, what do we know about non-advised investors? And that is our focus mainly in today's webinar. Well, we know across the UK that 27% of adults have got some sort of an investment product. We know when it comes to DIY investors, the average age is 48. That's dropped over the last sort of 5 years. It used to be up higher. It was nearer 5 or 6 years ago, about 55. So that's being sort of brought down as more people go into the online investing space. But it is still a sort of very male audience. So that's what the kind of DIY platform user looks like. But of course, let's not forget the impact of auto-enrollment and workplace and DC pensions. And that's interesting. I'm going to touch on that when we think about comms, because they're a younger audience, they're a less experienced audience, and they are really struggling at the moment. So I think we need to think about comms for that audience in a rather different way. This is a slide I talk to quite a lot. People are not confident, even the DIY account holders. So we asked them, this was a nationally representative audience, and we asked people who are investors how confident they would be in opening up a new investment product there. And you can see, and this is existing investors, right, that nearly half only give themselves a confidence score of between 0 and 5 out of 10. And of course, for cash savers, the concept of opening up a new investment product, the confidence levels there, you can see 65% score themselves between 0 and 5. And I think we have to really continually remind ourselves about those low confidence levels when we're talking to our customers. So let's have a quick look at changing behaviours. I I picked out this sort of picture. I looked on the internet for pictures of sort of younger, smaller, and more mobile, and I got a very cute picture. And then when I kind of Googled pictures for promiscuous, well, of course, I couldn't use any of them. That was an entirely new challenge. But beyond the pictures here, I make a really serious point, which is the last time we saw similar crashes in 2008, RDR hadn't happened then. More people were advised, and the DIY investor community was older, it was savvier, it was a more hobbyist audience. So now I think we've got to think about, well, how do we need to respond as companies post-crash to this slightly different audience? It's a younger DIY investing audience. They've got smaller balances typically. We know that 14% of online ISAs have less than £1,000 in them. Now, people are also on their mobiles. They're trading more, they're checking balances, not necessarily behavior we want people to be doing when the bottom's falling out of the stock market. And people are more promiscuous, they've got more accounts, they're shopping around more, they're more likely to think about switching. So we have to remember that. I'm going to look now at just this mobile trading, because I do think as well this is impacting how people are responding to current events. So you can see there that people with investment accounts, those are the purple bars, over the last 12 months, 46% of people with online investing accounts have checked the balance on a mobile. And we've seen mobile trading as well go up. You can see that 18% of people with stocks and shares ISAs have bought or sold an investment on a mobile device over the last 12 months. So we're talking to an audience which is actually 24/7, and they're looking at their balances, and the mobile is there in their hands, almost encouraging activity. So people more likely, I think, than they were 10 years ago to feel the need to somehow respond to a market crash such as the one we've seen. So what do people want at the moment? Now is not the time, I think, for us all to sort of be able to really analyse the lack of trust in our industry, but it is something pervasive, and it is something that impacts what people tell us they want. They want the ability to get their money out at short notice, and that is true for both investors and for cash savers. So again, that lack of trust has created this customer base which is jittery and has got sort of quite high up in their minds the ability to sell out and to get access to their cash. And we need to keep that in mind at the moment as well. And so pre-crash, let's look at the research we did just in January this year, which feels like eons ago, doesn't it? But when we talked to people in January, people were a little bit more positive about the industry than they had been 12 months previously. Not much in it. You can see there a little bit more positive. That's the green slice of the pie chart. That's 28%. A little bit more negative, 22%, and a big chunk of people sort of fairly neutral. One thing I think is interesting, I'll touch on a little bit in this as we go, is the role of ESG and sustainable investments in generally improving the reputation of the industry. And I actually think that ESG and sustainable investments will be net recipients of the coronavirus crash that we're seeing. We also saw in January, a very real impact on investor confidence and sentiment from Woodford, which I think is interesting as well. There was a slight taint and a pollution after that about active investments. And so I'll show you later up, there's investor sort of comments now saying that when they're planning to come back in, they're thinking more about passive investment. So a few things to sort of highlight there. And this is, of course, what people were saying back in January. And when we look at sort of people's confidence and what they were sort of thinking moving forward, again, we can reiterate that lack of confidence that even the DIY investors have. Just 20% of people talking about their pension and again about their ISA, confident that they were invested in good investments. And this was at the end of the bull run, right? So you think about that kind of quite low confidence levels then, and then think, well, how things have changed now. So that was all life before coronavirus. What do we see now? And just a sort of question for you guys, sort of poll time, do you feel confident that your firm's been responsive and or clear enough with their comms for customers? And if you scroll down, there is that poll there. You can see we've had a few responses from people there. The majority of you saying yes, you do feel that you've been responsive and or clear enough with comms, which I have to say, as someone with 30 test accounts, I think is perhaps excessively confident, based on my experiences as someone with those test accounts sort of coming through. But by and large, you think your firm's been responsive and or clear enough with the comms. So let's now go to what we heard about sentiment in response to the survey we did in Q1 this year, which we did with over 600 Boring Money readers. And so this was going out to people effectively last weekend. So this was after we'd seen the first sort of tanks in the markets, and we wanted to take the temperature of how people were feeling. Now, bear in mind that this is to the Boring Money audience. This isn't nationally representative. It doesn't necessarily mean that they're all hobbyist investors. We have a very sort of wide cohort from people who are first timers, who might have put £1,000 in a robo account, right up to sort of some of our readers who have millions of pounds and use us to sort of validate things. So it's a broad church there, but on balance, probably slightly savvier than a nationally sort of representative audience. And I thought this was interesting, actually, even last weekend when we asked them about the outlook for economies, just half said that they thought the global economy and the UK economy would get worse between now and the end of 2020, which to me feels a little bullish. We asked people as well back in January, so back in that NatRep survey, just as a sort of contrast, what they thought. Now, back in January, 39% the NatRep audience said that they thought the global economy would get worse. So we can see the biggest sort of shift is in outlooks that people have from then. That was January. If I go back now to what we asked last weekend, 51% of people saying they thought the global economy was going to get worse, but still relatively bullish sentiment out there. Now, despite that, when we asked our audience last weekend what they thought would happen to the FTSE over the next month, the majority of people there, 51% in total, thought it would fall again by more than 5%. And of course, it's been an incredibly volatile week. It's every time I check the FTSE, it's up and it's down like a yo-yo. But in fact, this week it is up by 9% as I last looked from the beginning of the week. Unprecedented volatility. But our audience we checked in with did anticipate further falls, and 10% they're saying, well, further falls. Don't forget, when we asked this, we'd already had a 30% fall of more than 15%. And so I just wanted to share some comments with you, because I think sort of people's verbatims quite often kind of bring colour to this. So the majority thinking it would decline further. I'm sharing some illustrative comms with you here. And the one I've bolded there, I don't think people have got their heads around how big the direct and indirect impacts of this are going to be. So lots of people there saying we haven't really factored this in yet. A few optimists, who, one of them describing it as a knee-jerk reaction there. Another person, I think, actually possibly excessively optimistic, who knows, saying that the January highs won't be seen again until 2021. One of the most marked things I've seen and heard from our readers is a gulf, really, between the older investors and the younger investors. Of course, the older investors have been here and seen this before, and you can see there's such a big difference in people responding. I've seen this before, I don't like it, but I'm not worried. So 6 out of 10 of older investors are sort of falling into that camp. And then you see how that really rapidly drops off for younger investors. So I think it's worth thinking as well about your particular audience and their age. And this goes back to the experience and the confidence. And certainly if people have been through 2008, as you would expect, they are a lot more sanguine about this. A particularly sort of Victor Meldrew-y reader sort of sent me that in here, but there is a sort of almost harumphing amongst the older readers that we have, saying we've been there, done that, seen it all before. I'm just looking at the comments. Can anyone else see the comments that are coming in from someone? I don't know, BM team, if we can I can't quite work out how I'm supposed to respond to some of those. There's about local town councils, so I think I'll just blank the comments and carry on. Now, this is something else that I'd sort of say was really striking, is what are people planning to do? So we've heard from our audience, people anticipate further falls. They're quite sanguine about it as a group. Some of them are saying it's an opportunity to buy back in. And look at when we sort of said, okay, if you're looking at buying back in, what's the strategy? How are you planning to do it? And you can see there that the majority of people saying, I'm going to use trackers. And I think we're getting the sense, and what people are writing to us, is they're not particularly confident. They don't quite know what's happening at the moment. So the ability to pick a particular region or to pick particular stocks, they're not comfortable with that. So they're looking to trackers. And I think there's a really interesting, I haven't really seen much at all this week from active fund managers out talking about this. And perhaps you would think now that this is a time where you might be able to make the case, perhaps more vociferously, for active fund management. But I think there's some more we can tease out of that. But lots of comments from our readers about the planning to use trackers moving forward to come back in. So we've also got the sanguine, and this is the sort of majority of our audience who are actually saying, I don't like it, I've seen it before, people thinking about the bargains to be had, people looking at some of the stocks which have been absolutely sort of hit and saying, surely these are good opportunities. And I talked a little bit earlier about ESG, and we're starting to hear about that. And I think actually we are going to see more people coming back into the market or repositioning their portfolios, looking at what our reader here has called ethical or socially responsible companies. Will they weather the storm better? And that's something we're going to tease out more over coming weeks. We have a whole heap of people who fall into the anxious category. And for those of you with a DC customer base, you're more likely to have people in this camp who are anxious. They're hearing the logic from us about not kind of having a knee-jerk reaction and selling, but it doesn't mean they feel any more comfortable about it. And someone there, you can see in one of the comments, I'm keeping it based on cash is king mentality, and that is certainly something that we're hearing day in, day out from investors. Cash is king, something as a small business owner I can well relate to. And then, of course, many falling into the worried camp. We'll talk about drawdown customers in a second, but sort of people who are kind of in retirement, worried for obvious reasons. And also some people just sort of looking at, this was last weekend, remember, one of our readers saying, I'm expecting the UK to be in lockdown very soon. Look at what's happened to Italy. So a few sort of people saying, I don't think we've quite seen the totality of the stock market falls that we're going to see. And drawdown, again, I do think it's harder. I find when I'm asked to write content for drawdown customers, it is much harder because it's harder when you're writing for people who need to, if they've got no other cash at their disposal, they need to sell down. It's a much harder thing to talk to people about. So particular need, I think, for strong and very targeted comms at people in drawdown. You can't send out the same broad brush set of comms, I don't think, to someone in their 30s in the accumulation phase as you can to someone in their 60s in drawdown. It really does need quite specific and focused comms and support for that audience. So last question coming up, I'm interested for our audience, do you think people are most worried about? And again, if you sort of scroll down, you can see the poll there. It's interesting just to sort of test and take the temperature with you guys about what you think people are most worried about. It may be that you feel quite remote and you don't know. Interested to hear. Looking down a few answers there: navigating pension freedoms, managing drawdown, and knowing when to buy in, which is interesting. Not anyone there saying selling out as quickly as possible, which is slightly different. We've been working with a few groups who have been feeding through the MI from their call centres to us to help us to determine the content that we're producing for them. And we are getting quite a lot of reports from the call centres about people just saying, I want to get my cash, I want to get my money out. But from what we're hearing from our audience is people worried about when to buy in and managing drawdown, which suggests to me that the people responding to our polls are running platforms, DIY platforms for more hobbyist investors. So moving on, just a conclusion in the few remaining minutes. What do we see lying ahead? Well, in our report, which we republished in February, of course, we made predictions, didn't we? So we looked at platform AUA, which at the end of last year was £261 billion. And we saw growth last year of nearly 21% in pound terms of that. Now, of course, since we published that, we know we're starting to get now sort of Q1. We'll start to get Q1 data trickling in the next few weeks, but we know alone that the sort of markets have fallen by 20 to 30%. So actually looking forward, we'll be able to sort of draw a line which will look a little bit more like that moving forward. So obviously huge impacts across the board and ongoing volatility to be expected. We've also looked at anticipating market shares, and this is by customers, not by pound amounts. And we did a lot of research last year with end customers about the impact, the knock-on effect of Woodford. A few other interesting market factors to put in there. Vanguard launched their SIP. A lot of customers had been waiting for that. Mixed reviews about the Vanguard SIP, a lot of people waiting for more functionality, and of course drawdown to come in there. But we did hear from people that had been putting off switching, waiting for that to come into the market. And we've also forecast a sort of relatively big uptick for robos and digital advice, which of course includes some of the new bank propositions out there. So projected changes we made in February to share of customer by provider. I think this will be slightly mitigated by what's happened recently in times of uncertainty. People tend not to switch platform providers so much. People tend to value big, solid companies. So in a way, I think we'll see a slightly lower switch out rate from Hargreaves than we may have seen, all things being equal, moving forward. And so just summing up for you guys now, the key customer questions which we're hearing across the board. Firstly, I mean, I think we underestimate this. People don't understand the potential for capital losses with stock markets in such kind of wild times. People do still worry it could be left with nothing. I think we need to go out and do a better job in explaining why that's very, very unlikely to happen. People want to know what to expect. How low could this go? There's appetite for hearing about other stock market crashes, about precedent there. People wanting to know if they should sell, if now is the time to bail out. But also people then wanting to know when to buy in. Like how do I time this? And when I do come back in, what should I be buying? And then, of course, I've talked a wee bit today about drawdown, the very sort of specialist set of questions coming in from people there, which need very focused answers. So that brings us to the end of our first webinar. Apologies about some of the hiccups. I know you all heard him swear earlier, but Mackay has been an absolute legend working remotely, supported by Jamie and Phoebe, getting this all up and running. We'll get better at it as we learn, but well done, team, for pulling this together. Please do come and talk to us at the moment. We are working flat out, helping groups with positioning and content. By popular demand, we are now starting to make syndicated content available to people who can't keep up with the rapidity of comms that you're being asked to produce. We're checking in with our audience the whole time, so come to us about our customer sentiment and reaction to things as they move, as they change. And if you haven't heard about our online investing report, we'll send the link to that and sort of follow up about how that can help anyone with a DIY investment or pension proposition or audience there. See you next week. For our next webinar, we're going to look at best practice, and we're going to kind of lift the bonnet up and look into our test accounts and share with you what works, what doesn't work. It's good for UX people. It's good for people trying to tackle drop-off rates or problem areas in the customer journey. We are out of time now, so high five to Mikhail. Thank you, all of you, so many of you, for dialing in, and keep calm and carry on, folks. Only 5.5 hours until we're socially and legitimately allowed to have a glass of wine. Well done, thanks, and bye-bye.